So what if I told you that the entire global economy, the whole thing, could be brought to its knees by a single, really simple idea? An idea that sounds so good, so right, it feels like it should be a fundamental right: owning your own home. Let's dive into the story of how that one simple dream got twisted and ended up triggering a financial meltdown that honestly changed the world forever. Our story really kicks off with this number: $600 billion. That's how much money, how much value just poof, vanished almost overnight. This was back in September 2008, when Lehman Brothers, a 158-year-old pillar of Wall Street, just collapsed. And look, this wasn't just one bank having a bad day. This was the first major tremor of a global earthquake. And this was the question that lit the fuse. You saw it everywhere, on billboards, you heard it in seminars. Why rent when you can own? It was the seductive promise, right? It was selling a piece of the American dream. But for millions of people, it ended up delivering a global nightmare. Okay, to really get how this all went down, we've got to jump in the time machine and rewind a bit, back to the early 2000s. After the dot-com bubble burst and the shock of 9/11, the U.S. economy really needed a jump start. So the Federal Reserve's big idea was to slash interest rates down to almost nothing, making money incredibly cheap to borrow. So with all this cheap money sloshing around the system, banks got, well, let's just say they got creative, finding people to give it to. They pretty much tossed the old rule book right out the window. This gave birth to the now infamous Ninja loan. And yes, it stands for exactly what you see here: no income, no job, and no assets. Essentially, if you had a pulse, you could get a mortgage. And the market just went absolutely insane. It was like a national obsession. Flipping houses became a national sport. And the one core belief that was driving all of this, the engine of the whole machine, was this incredibly dangerous assumption that housing prices could only go up. They always had, right? Until they didn't. Okay, so you've got millions and millions of these super risky subprime mortgages out there. To you and me, that sounds like a giant pile of toxic debt, a disaster waiting to happen. But to Wall Street? Oh no, to them it was the raw material for a fantastic magic trick: how to turn financial junk into pure gold. So here's how the trick worked. First, they took thousands of those risky loans, the ninja loans, all the bad credit stuff, and they bundled them all together into something they called a mortgage-backed security, or MBS. Then they took those bundles and sliced and diced them into even more ridiculously complex things called CDOs. But here's the final crucial step. They paid ratings agencies to slap a AAA label on this stuff, the highest, safest investment grade you can possibly get. This quote just nails the problem perfectly. It was a massive conflict of interest. You see, the ratings agencies, the supposedly impartial referees in all this, were getting paid millions by the very banks whose products they were supposed to be judging. They knew a lot of it was garbage, but hey, the money was just too good to say no. But, not everyone was drinking the Kool-Aid. There was this small group of outsiders, some real oddballs, who looked at this whole system, saw the rot deep inside, and they decided to do the unthinkable. They wanted to bet against the entire U.S. housing market. Now, to make a bet that big, they needed a new kind of tool. So they basically walked into the big banks and said, hey, we want to buy insurance on your mortgage bundles. And Wall Street, smelling what they thought was easy money from freemiums, because hey, the housing market never goes down, right? They said sure. And they created something called the credit default swap. And here is where things get truly wild. You didn't even have to own one of these mortgage bundles to buy insurance on it. This created this bizarre shadow market where people could actively bet on the failure of things they had absolutely no stake in. It was basically a casino built right on top of the housing market. So now, all the pieces are in place. You've got a mountain of bad loans, all disguised to look like safe investments. And you've got a side market betting billions and billions of dollars on whether this whole thing holds together or just blows up. The stage was set for an absolutely epic collapse. This is the perfect metaphor, isn't it? Every single bad mortgage was a loose block in the tower. Every complicated CDO was just another shaky layer they built on top. And for years, Wall Street just kept pulling blocks from the bottom and stacking them on top, totally convinced that the tower could never, ever fall. And then someone pulled the wrong block. In 2007, for the first time in ages, home prices actually started to drop. All of a sudden, homeowners owed more on their mortgage than their house was even worth, and defaults just skyrocketed. Those safe AAA mortgage bundles, they were revealed to be radioactive. Panic hit Wall Street, and on September 15th, Lehman Brothers went under, triggering a full-blown financial heart attack across the globe. And here's why that was so catastrophic. When Lehman failed, trust, the one thing that makes the entire financial world go round, it just evaporated. Banks stopped lending money to anyone, even to each other. The credit markets, which are like the lifeblood of the global economy, they just froze solid. Businesses couldn't get loans to pay their employees. The entire system jammed up. This left the US government with an absolutely impossible choice. Option A, let the entire financial system burn to the ground and take the world economy with it. Or option B, bail out the very institutions that started the fire in the first place. They chose the bailout. Congress approved the $700 billion Troubled Asset Relief Program you probably remember as TARP. The plan was, in essence, to use a fire hose of taxpayer money to stop the fire from spreading by just shoveling cash into the burning banks. And it wasn't just the banks. The insurance giant AIG, the company that sold all those insurance policies on the bad mortgages, got a massive $180 billion lifeline. Even car companies like GM and Chrysler were deemed too big to fail and got a slice of the pie. On top of the bailouts, the Federal Reserve unleashed its own, let's call it a money cannon, known as quantitative easing. Now, in simple terms, they basically started printing trillions of digital dollars to buy up all the toxic junk from the banks, hoping to unfreeze the whole system. And you know what? It kind of worked. The market stabilized, the stock market started its long, slow crawl back from the abyss. On Wall Street, you could hear a collective sigh of relief. But for pretty much everybody else, the pain was just beginning. This slide just lays it all out there. There were two very different aftermaths. For Wall Street, the bonuses came roaring back pretty quickly. But on Main Street, 8 million jobs were lost, and 4 million families lost their homes to foreclosure. Think about that. The people who caused the crisis got bailed out. The people who paid for it got pink slips and foreclosure notices. All of that simmering anger, it eventually had to go somewhere. And in 2011, it boiled over. Protesters filled Zuccotti Park in New York, and the Occupy Wall Street movement was born. Their slogan, "We are the 99%, was a direct response to a system they saw as completely rigged. A system that socializes the losses but privatizes the profits. A system where not one major CEO ever went to jail for the crisis. And that really leaves us with this final critical question. The rescue efforts, they stopped a second Great Depression. There's really no doubt about that. But in bailing out all the players, did we ever actually fix the fundamental flaws in the game itself? It's a question that is still hanging over our economy to this very day.